Today's topic, going against the grain. As an advisor, sometimes we have to offer advice that some folks may not like. So we have gathered a few ideas, some questions that we feel many can benefit from. So let's sit back and get into a little straight talk. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. Welcome. This is a new series thought about, planned on, never really executed on, but finally we've gathered all the data, the questions, ideas, where we feel we can put together some really good topics and conversations to help our pre-retirees and retirees. So please do consider subscribing, available here on YouTube and also in all the various podcasting platforms. So today's topic, going against the grain. As I said, sometimes we have to offer advice some people may not like. Some people might have a contradictory opinion. That's okay. So we've gathered some questions here over time and want to go through a couple of those. So the first one is, what is the appropriate amount of risk for a pre-retire retiree? Well, here we are, October 2022, obviously in the middle of a downtrend, bear market, possible recession. So risk is on everybody's mind right now. So we've got a probably different opinion here. You know, we go through the questionnaire when a client comes on board. We get that appropriate risk tolerance score like everybody does. And then we have a conversation, right? Because sometimes people come in too low, sometimes they come in too high. So we want to make sure we've got them in the right parameters for their long-term objectives. Now, most clients, especially in retirement, are more moderate, okay, can handle up to 10% in losses. And moderate would be defined as a 60 in equity, 40 in bonds. But, and here's the thing, to me, I think when you have to look at the market, say 2021, clearly in an uptrend, clearly in a bull market, let's take advantage of that. So that's 60-40. We might push to 65. We might push to 70, okay, in equities and take advantage of that. Now, in the current environment we're in, same thing but opposite. We want to make sure we're not taking on too much risk. As of this recording, we're about 70% in cash, because both stocks and bonds are down, and we really want to mitigate and reduce those mixes. Now, we've got a unique investment style. I'll put a link here to our latest video on a market update if you want to learn more about that. So, again, we take care of it. Depends on the individual. We have those conversations, and we move those numbers when the markets move as well. So, next up, how much cash should I have on hand? I mean, standard is 3 months, sometimes 6 months. It depends. Now we're entering into potentially a recession, a deep recession. Maybe we need 4 or 6 to make sure you're okay. God forbid somebody gets laid off. So I think that's a pretty fair number. Next question, how much insurance should I keep? Well, this is a tough one, right? Nobody really likes insurance, obviously, because the ramifications of insurance, you're not benefiting from it, somebody else is. So the answer to that is, it depends. Okay, for me, I look at insurance in a financial planning aspect. So we do wealth management, financial planning. In that financial planning aspect, one of the components is insurance, long-term care insurance. So insurance, a while ago, used to be used to help pay for estate tax and things like that, but we have such a big number on that, most folks are not affected. So I will generally look at, propose some type of life long-term care option, not long-term care on its own, but they have hybrid products. So it depends, right? If you look at the cost of long-term care today, generally we try and get policies anywhere between, depending on the individual, $300,000 to $700,000. Also, obviously, have to factor in the cost of that, but that's on an individual basis. Next up, should I pay off my home? Good question, get it quite a bit. Once again, it depends. How much cash do you have? Can you pay off that home? Now, we see a lot of folks moving to my community from New York, New Jersey, Northern Virginia, so they could sell their home there, buy an equivalent home for significantly less, and be able to pay that off. If it doesn't affect the plan, no question. But liquidity is everything. So there's two parts of liquidity. One, how is that going to affect your liquidity and your need for income? Okay. Number two is home is not liquid. Now, you can get a line of credit. Some folks have reverse mortgages. If that's the case, we could put that in there and we can utilize that or tap that where needed because things happen, right? When you go through over time, roofs need to be repaired, air conditioning, all kinds of different things can happen. So as long as we have the liquidity, then we can pay it off, but it does in fact depend. So mutual funds versus ETFs. So big one here. So you look at my background, I came from what's called the distribution side of the business, worked for, ran a big mutual fund company on the sales side of things. But I'm an ETF guy. Why? Simple. Cost is number one. Obviously, ETFs, exchange traded funds, are much cheaper than a mutual fund. So I like it for that reason. Number two, tax efficiency. Way more tax efficient. I was talking with someone recently, got a big hit in their tax bill last year from capital gain distributions and really messed up their tax returns. So more efficient on the ETFs. The last one, most importantly to me, is the pureness of the ETF. What do I mean by that? You can have a mutual fund if you look at the prospectus. Not many do. A large cap growth might have mid cap and small cap in there. So when I buy and I allocate and I build our models, I want it to be pure. So if I want a sector, I want just that sector. If I want large cap growth, I want large cap growth core only, period, end of sentence. So that's another big reason. So I believe ETFs are better for investors. Like I said, I think fees, taxes, and then the pureness of the overall fund itself. So first episode, hope you enjoyed it. Have some more coming. Make sure you do subscribe. Look forward to seeing everyone. Of course, if you're in a podcast, maybe not. But we will be back. Thanks so much. Michael Loftus, Wealth and Wisdom TV.